One of the lines that I think Barack Obama uses is, "Gee, we used an antiquated regulatory system to regulate a 21st century financial markets," and I think he's right on there. The financial markets truly have changed dramatically in the last 10 years. So what Barack Obama is describing is we didn't build a regulatory system to keep up with what's going on in the financial markets. Financial markets were becoming much more liquid. Markets that didn't exist 10 years ago are now dominating the market, like hedge funds. Hedge funds now represent, I think, 50% of the trading in the New York Stock Exchange. And that money is very, very liquid. It can move on an hour-to-hour basis. So it used to be the U.S. market was the U.S. market. Now we really have a world financial market. It's no longer just simply a U.S. market. And so worldwide problems can affect country to country very, very quickly. And it's okay to be unregulated, but the government needs to keep tabs on who is doing what. So if there's a problem, what happens? And frankly, there's no clearinghouse. One of the recommendations I would have is to have a clearinghouse where at least people know who's on what side of these transactions. The consumer right now is very, very comfortable with debt. Debt is being thrown on consumers. We're a consumer-focused society. It satisfies our needs immediately. Savings is very low. And the consumer, without the consumer to be fueling and wanting to borrow money and feeling comfortable borrowing money, we wouldn't have had this mess either. So I think we all need to take some blame for if we can't afford it, well, borrow it. And you can afford that car that you can't afford or that house that you can't afford. And I think that's generally human nature, but at the end of the day, we all just have to recognize that there's a price to pay here. The Federal Reserve controls the money supply. They managed money where the cost of money, the Fed funds rate, dropped to 1.5% in 2003. Give you some sense, today it's around, I think, 5 or 6%. It's I think a couple of years before it was 5 or 6%. 1.5% is below the inflation rate. And so they almost artificially lowered interest rates where it was so cheap to borrow. And all of a sudden, I was looking at that, at the rates that we were borrowing at, and we go, wow, this is very, very cheap to borrow. Why not borrow, especially when you have real estate values going up? And so that Fed easy money policy created even more fuel to the real estate boom. Now I can afford, instead of a $200,000 house, a $220,000 house. And all of a sudden people are literally, going to the brink, if you will, and borrowing as much as they can without any cushion. One of the things that most of us aren't financially sophisticated to figure out, well, if I'm investing in a money market fund, what am I investing in? We don't care. What we typically say to our broker is, I like to invest in a AAA bond or a AA bond or single A bond. And frankly, that should be good enough. And because we're not all financial experts, and so the credit agencies, S&P, Moody's, and Fitch, that basically control the entire rating agency, they were asleep, and they frankly didn't understand the risk that they were rating. And so when all of us were looking at securities and saying, well, it's AAA rated, what more can you ask? And it's a legitimate question. Frankly, it's the question I ask when I'm investing in a bond or money market: what's the rating? There's something called in the financial accounting mark to market. It basically says you should value those securities on your balance sheet every day. And so if the stock goes up or the stock goes down that day, you should reflect that value on that a daily basis. And so what used to happen is those things would be slow to react. And so when you had securities declining in value, like was happening over the summer, and literally there were no buyers, well, what's truly the market? I mean, there's no market at that moment. Now, these are securities that have value, and when panic sets in, what marketing did is it exacerbated the problem and made the problem much, much worse, because all of a sudden losses started happening much more quickly. And so people didn't build into their financial models panic. And anyone who follows booms and busts, panic sets in, and we have to figure out how to manage our booms and busts a lot better than we'd have before. There have been bubbles before, and we didn't have this type of mess, but truly there was a loss of confidence. And Wall Street was built on, the financial system is built on confidence. And so when the confidence started eroding, in 2007, and then 2008 with the bankruptcy of Bear Stearns and Lehman Brothers, people started to panic. I can probably say that from a economics point of view, things are going to get worse in the next 2 years. And so what we have right now, and you've heard a few politicians, I think Paul Volcker, said it, the economy isn't in that bad a shape, but now obviously you're going to start to see it start to deteriorate in a big sort of way. And so what you're going to have is all the results of what you've just seen on Wall Street now permeate throughout the economy. So you're going to see most notably a lot of layoffs, and what layoffs cause is lower demand, lower sales, lower profits, and so it becomes that cycle. And that cycle, to my best judgment, is probably going to last at least 2 years. You'll see bank failures and the like. And so, the stock market is a leading indicator. Will it go down much more? It's hard to say. One of my fears, like everything else we do in politics and in regulation, is we go from one extreme to the other extreme. And what we may start doing is taking a system that was that really fueled at least the U.S. economy, frankly, since its inception, but really fueled the economy, especially in the 20th century, and is this great financial system of ours. And now what we're probably going to do is over-regulate it, over-control it, take the risk out of what frankly is a risky business. Investment banking really almost doesn't exist like you're describing it, like people talked about it, 2 months ago. Those investment banks are now part of commercial banks, part of larger companies, and it's really going to be a different business model. And so for college graduates who are looking at career in investment banking and making a lot of money, there are no investment bankers left anymore. The last two, Morgan Stanley and Goldman Sachs, are converting to a commercial bank, and the reason is they're now going to be much more conservatively run, because commercial banks have to be more conservatively run, and therefore they won't be able to pay the big salaries, probably won't get the best and brightest, and so for those folks who are going there purely for the money, okay, the money will be far less. They're taking less risk. Those banks will be less profitable, and they won't be able to pay the salaries that they were paying, starting MBA students or students with finance degrees. MBAs, I think, are always going to be in demand. I mean, I think there's a huge pockets of business that just MBAs are in great demand, and so if you look at certain industries that will be booming in the next 10 years, the environmental area, aerospace, an industry that I'm familiar with, has been booming. And so the international finance is a terrific area to get into. You have all these developing countries with economies growing far faster than ours, needing people to help manage that. People with financial backgrounds, especially accounting backgrounds, are always in great demand. And so the accounting profession since Enron has frankly boomed. China definitely has more and more bankers are going there. More private equity firms are now opening up shops in overseas, and this is something that literally probably didn't even exist 10 years ago. And so they're going where the economies are growing. Some of those economies are more regulated, but some are less regulated. Going into countries, and whether you're having your marketing hat or your financial hat, but doing the same thing that we used to do in this country in those other countries. And so folks that can be comfortable working in the U.S., understand the U.S. market, but then also understand the area of specialty, whether it's obviously China's the most notable one, but you have many countries that are growing very rapidly, whether it's Mexico, Brazil, India, and Russia. Russia's an interesting one as well. Well, I generally follow the smart money, and so if we look at private equity and venture capital, they're investing in the environment and the energy. I've heard many times over that that's going to be the internet in the next 30 years, and I think there's going to be tremendous innovation, whether it's an electric car, whether it's new forms of energy, whether it's lowering costs of solar and wind, and so that whole area is, I think, a terrific area. A lot of smart money is flowing into it, and there's a lot of money to be made.